Marty Sass, portfolio manager for the MD Sass Equity Income Plus Fund, is here to name some of his top stocks. Welcome, Marty.
Thank you.
All right, let's start off with International Paper. Pays nice 2.5% dividend. They raised prices this past summer. So will they be able to raise that dividend?
Yes, I think meaningfully. They pay a $1.20 dividend. We're estimating $1.50 this year. They'll raise it, and they'll raise it further. Plus, they'll probably do a large buyback. There's a lot of free cash flow being generated at IP. It's a consolidation play where they've consolidated the paper industry. A lot of key markets in paper. They now have 20% plus market shares. Let me also put it in context of this equity income plus strategy, where what we're doing, Greg, as you know, is we're buying high-yielding stocks that we think will grow the dividends at an attractive rate, and we're writing out-of-the-money covered call options against it to generate more income. So we're generating in our fund an 11.3% annualized cash flow from option premium sale of calls against IP stock, the 2.5% dividend you mentioned. Plus, we expect those dividends to grow. We have some upside in the stock because they're out-of-the-money calls, and IP is up about 17% so far this year, so it's been a good stock to own. And then we protect the portfolio by buying protective out-of-the-money index puts.
All right, well, another stock that you like for that portfolio is Williams Companies.
Right.
Now, this company pays a 4% dividend. They own a whole lot of pipelines across the country. A lot of people like pipelines. What do you?
Right. I like the stock. As you mentioned, it's a 4.1% dividend, but that dividend is going to grow 11 to 12% compounded annually over the next 5 years. They have a $25 billion backlog of projects, of growth projects, over the next 5 years. They own WPZ, the GP, general partner and limited partner in this master limited partnership, which owns 3 major interstate natural gas pipelines. And so we've got a growth utility with growing dividends. Typically, I hate utilities because they don't grow and the dividends don't grow, but this is a big exception.
Well, you're also a fan of Foot Locker.
Right.
Well, there was a lot of talk when Bill Ackman was fighting with JCPenney's about bringing Foot Locker CEO Ken Hicks over to JCPenney's. We haven't heard that since Bill Ackman said goodbye to the board.
Right.
So will Ken Hicks stay? And tell me why you like Foot Locker.
Okay, I'm not sure whether or not he's going to stay, but it illustrates he's a really top-notch manager. Company is a leader, as you know, in athletic footwear, and is trading at a discount to the multiple. In fact, it's the cheapest stock amongst the apparel and footwear companies. Generating, again, a lot of cash flow. We expect that dividend to grow nicely, and it's an undervalued stock.
And then finally, you're a fan of Teva Pharmaceuticals. Now,
Right.
a lot of healthcare stocks, drug stocks have really exploded in the past year and a half, really done well. Teva, however, is down 2% in the past
Right.
year. So why do you want to stick with it?
Right. Well, actually, it fits this portfolio strategy beautifully because Teva is a stock which doesn't go below $38 a share, so that's where you want to own it. It's got low downside risk. It's trading at 8 times depressed earnings. It's generating a 3.3% yield, which we think will grow. It's in an attractive area, generic manufacturers. By the way, our biggest holdings in our long-only portfolio in that area is Actavis and Mylan, which have done tremendously, and we think will continue to. But Teva, when you combine the dividend yield plus the option premium, you're getting a double-digit standstill return with low downside risk and the possibility of some reasonable appreciation as well.
All right. Thanks a lot.
My pleasure.
Thank you for watching The Street.